Hello, wealth hackers. As you may know, I've been dabbling a bit in stock options, been trying to get rich with them. I had a lot of early success. I took a deeper dive. I even hired a coach who in turn became my stock hacking mentor because he simply loves to teach and share outside of my coaching time. He is an ex-Wall Street options pit trader. So if you've seen the movies where, on Wall Street, they're at the exchange, people are yelling at each other, hand signals, and there's pieces of paper flying everywhere. That was Leigh back between 1991 and 98. I already dropped his name. He left that job. He left that rat race in order to move to Hawaii and to trade from home in paradise. Leigh Lowell is his name, obviously. Leigh is now a full-time trader, and so he's been trading for over 30 years. He is a best time selling author of Get Rich with Options, and he's also referred to as the Godfather of Stock Options. You may recognize this book, Leigh Lowell's Get Rich with Options, because it was required reading for the original Stock Hacker Academy before attending the course. He literally wrote the book on the subject that became foundational reference material for all past and future stock hackers. So it only made logical sense that we partner with Leigh to bring you all wealth hackers the all new Stock Hacker Academy version 2.0. To register, go to www.stockhackeracademy.ca/special offer. Again, that's www.stockhackeracademy.ca/special offer. All the details are there, including the dates. Prices go up April 22nd, so don't delay. The crash course weekend is April 25th and 26th, 9 to 5-ish, Saturday, Sunday. The timing honestly couldn't be any better, as Leigh predicts the bottom of the stock market is only just a few weeks away. Needless to say, my stock hacking game has improved 10x, the skills I've learned, the strategies I've refined while dialing down my risk. Leigh loves to teach and share his experience, and he's been investing through 3 major economic meltdowns and recoveries before this now COVID-19 related correction we're in now. I honestly don't know anyone I'd rather learn from right now in this environment. In real estate, I've always said a real estate expert has invested through a full cycle, a full economic cycle. I invested through the 2008 credit crisis in 2012. 12 years ago in 2008. Leigh has been through 3 economic cycles. 3. Hence his experience in managing risk through this current downturn and how to maximize returns during the eventual recovery has me beyond excited to maximize returns during this recession. Yes, I love real estate. I always will. It's not like I'm selling anything. I'm hanging on to everything I got. And it's the best investment in the world. However, the stock market dropped by close to a third. The real estate market in my target areas, they're on pause, as physical showings and open houses have virtually stopped. Personally, I'm taking this social distancing time to learn a new skill that will make me money from home. We're all stuck at home anyways. May as well learn how to maximize returns while we're here. I can't even mow the lawn at my investment property right now if I wanted to. As always, I'd love to learn, and I love sharing anything that's new that will help you all make money, especially with stock prices being as cheap as they are right now. So I'm beyond excited again to announce the all-new Stock Hacker Academy version 2.0 in partnership with Leigh Lowell. This course is completely rebuilt from scratch and in my vision. I've taken all the feedback and lessons from the first course, and I've 10x'd this new program into 12 months in order to give our students the highest probability of success. Yes, this isn't for everyone. I know some of you don't like stocks. Those of you who do want to learn something new and willing to commit some time to learning and practicing will succeed. I've seen it many times. Leigh and I are here to provide the education. Only those willing should enroll, but knowing many of you came a long way in your real estate journeys, stock hacking is a brilliant compliment. My wife Cherry and I are trading HELOC money from our investment properties in order to make more money. Don't you love it? Your investments have babies, which is more money. And then with those babies, I will have more money to be paid with. Maybe not the greatest analogy. All you really need to do is take the full course. It's a 12-year program and own a smartphone. That's all you need to do. Actually, I don't even own my smartphone. I lease my smartphone because I'd rather trade that money. I'm being serious here. I put 0 money down on my smartphone in order to improve my cash flow. As part of the 12-month program, you get 2-day live streamed course with Leigh Lowell himself. All recordings will be available to you should you want to rewatch them at any time. The 8 weeks of webinars where Leigh will continue to teach new strategies and take your questions. Leigh's newsletter. So Leigh's newsletter is excellent. I'm a paid subscriber myself. He's been writing for it for 15 years. He writes it in plain English. He's extremely transparent with his trades. He gives you all the details. You can tell he really cares about his subscribers, and he has the skills and experience to limit their risks. We're gonna do monthly meetups at my office for a year, monthly. So I think you guys know I love to network and share. In person is best once the social distancing ends. So we're all going to network with like-minded stock hackers. We can look over each other's shoulders in order to get help, or you can just simply hand someone their phone. If you can't figure something out, just hand somebody else your phone and they'll figure it out, including myself. Ask your questions live and in person. Nothing beats in-person meetings and learning and sharing and networking. We're going to have a private online support group. We have months. This is a legacy group that already exists, so there's months of questions and answers and interviews with Derek and Leigh that are posted there. Derek Foster, if you don't know who I'm talking about, you can stay in touch with your community for 24/7. We have a quick start guide my team designed for stock hacking purposes. So it's specific to what we need to do. So you don't have to go digging out there over the web trying to find how to do certain things when we've customized it just for our purposes, for the stock hackers' purposes. It will honestly take weeks off of your learning curve in using the mobile app, because we found that many people still have challenges with the mobile app. Again, we can crush a lot of those things with the quick start guide and with the in-person meetings. The timing really couldn't be any better with the market down almost 30%. And it may even go down even more. Just look at the other opportunities out there. The real estate market's on pause until the virus goes away. Private lending rates don't interest me at all when I can just stock hack high yield dividend paying companies and have equity upside. Like my favorite stocks are paying like 7 to 10% right now, dividends. And again, there's upside because they've been hammered on the price. Why would I private lend? We'll cover this too in the course. We're all stuck at home anyways, so you might as well learn. You might as well come out of this having learned a new skill. To register, again, that's www.stockhackeracademy.ca/special offer. All the links and everything are in the show notes. Again, you're stuck at home. You may as well learn how to make money from home. The timing couldn't be any better because Leigh's own opinion is that the bottom is only 3 to 6 weeks away. The last correction was 12 years ago. I don't know if you want to be waiting another 12 years for a repeat of this type of opportunity. Again, it's www.stockhackeracademy.ca/special offer. So yeah, and guess what? He is our this week's episode and interview. So I'm proudly present to you my mentor, the Godfather of Stock Options, best-selling author of Get Rich with Options, Leigh Lowell.
A little bit about my background. I've been in the market for roughly 30 years now as a professional options trader. I've worked in New York City for a number of years. I'm no longer in New York City. I worked in New York City for a number of years, trading in the commodity pits in New York City on the New York Mercantile Exchange. I got my start trading energy futures and options, and that included crude oil, natural gas, unleaded gasoline, heating oil, contracts like that. I worked with a small group of traders based out of Chicago, and they had started a trading group in New York City, and they had operations around the world. I was part of a 4 to 5 man group in New York City. The way things like that, the way proprietary trading firms like that work is that they have usually one individual or a group of individuals who seem to be very wealthy and are willing to put up funds for other traders to trade their money for them and split the profits with them. And I was lucky to be employed by a very wealthy Chicago trader who had made his money in the Euro-dollar futures pits a long time ago. And he started up this operation in New York City. And I started as a clerk, and they trained me to become a trader. And so our goal was to just make markets, which meant we provide bids and offers for anybody that had an interest in buying or selling crude oil and natural gas options. And as a market maker, your job is not to guess or predict where the future direction of a commodity is going. Your sole job is to provide a liquid market of bids and offers at all times to anybody that wants to make a trade with you. And the way that you make money as a trader like that is you tend to buy on your bid price and sell on your offer price. So you're making money in between the spread there. And it was really not my job to predict the direction of oil in that case, because that's not what I was there to do. I was there to provide a bid and an offer. And when people customers of these other brokerage firms come into the pit and they say, "How's the X crude oil options?" and we would all shout out back that like you see on TV, all these traders waving their hands and shouting out at each other. It's very organized. It's very efficient. It may seem chaotic, but it actually functioned very well. So we were there to provide liquid markets at all times.
Leigh, have you heard anything how it is now? Since because it's all closed down now, right? The exchange, like, no one's there physically anymore, right?
Well, yes and no. I mean, there's a lot of the futures pits. There's futures pits and there's options pits. And most of the futures pits went all electronic roughly in 2008, 2009. And a lot of these guys were instantly out of a job overnight. I mean, it happened very quickly, just like what's happening now with the coronavirus. There's a lot of companies that are shutting down. And with the advent of electronic trading in 2008, it pretty much shut down a majority of the players in the commodities futures pit. Now, the options pits were still a little different because you needed options are a little bit more complicated to trade just based on the electronic screens, although they are trading there now. You still need options guys in the pit. So the options pits are still around for the most part. It's the futures traders that a lot of them lost their jobs, which is unfortunate. And the trading pits are no longer like they used to be, but there still are trading pits. I left that environment in 1998, so I had about a 10-year head start on how to trade off the floor and figure out how to adjust my trading style from being the one making the markets to the one having to take the markets. Market takers, you're at the mercy of the market makers in the pit. So I went from being a market maker to a market taker. In that case, I lost my edge as a trader. I was not there in the pits anymore. So I wasn't the one controlling the market. So I had to figure out another way to earn money for myself. And that was the time where I really started to learn how to read charts, did a lot of technical analysis, studying, read a lot of books, just read a lot of stuff online on how to read charts. And so since 1998, 1999, that's really been my life of trading off the floor on the screens like most people do today. You trade over the computer. It's just I had a lot of time to figure out how to make my living by learning how to see where the markets are going, and with the knowledge of options trading that I had, it worked very well for me over the years.
Yeah, Leigh, this trading is your only income source for your living, is it not?
No, not necessarily.
Sorry, the newsletter.
I do have newsletters that have taken over quite a bit of my income. As I got older and time went by and I started a family, that taking the risks that I was taking as a trader, I had to scale back quite a bit. And then also with the advent of the electronic trading in 2008, 2009, it was also a period of me to transition from scaling back some of my personal trading to writing the newsletters, because I had a lot of people asking me, how do I do it? How do I make money trading? Can you teach me about options? And that was sort of my entry into writing newsletters and how the book came about. I had teamed up with a publishing company, and they had asked me to write a book, and the Get Rich with Options book, which some of you have probably read, is where and how that was born. So as it is now, I write newsletters, and we do things like this online, and we get to talk to folks and teach them how to trade options a little bit more intelligently versus just speculating.
Do you mind if I show everyone one of your newsletters? I'll just show it on my screen. I'm not going to send it to them or anything.
Sure.
I'm looking for one of your recent ones where you talk about rolling a put, for example. Because some people don't think you should roll puts. Actually, let's talk about that, because a lot of people they didn't know what to do when they wrote a naked put, and then about February 24th when Trump said that the market looked really good, and then it kind of fell off a cliff for about 30%. Why do you roll puts?
Um, so I assume everyone in here, or most everyone in here, is familiar with selling puts. Is that correct? I
Yeah,
don't want to assume that everybody knows what that is.
I think everyone here's done it, and if they haven't, then they haven't read your book, and that's on them. Oh, wait, Leigh, by the way, we have 170 people on here, and many people said they read your book.
Okay, fantastic. Well, I'll just
The
give a
vast
quick
majority.
little. I'll give a quick little synopsis here. As we all know, there's call options and there's put options, and we focus specifically on put options. We sell put options, and when you sell a put option, what you're doing is basically agreeing to purchase a stock sometime in the future at the strike price of that put option. And what you're doing is you're really putting a line in the sand and saying, as of today, I'm going to agree to buy this stock at X price. And typically, if the stock is here, you're agreeing to buy it somewhere down below, further underneath where it's currently trading. So you're basically putting a line in the sand and saying, I will buy this stock if the stock happens to fall to that level. And when you sell a put option, the other person on the other side of that trade is obligated to pay you the entry fee, which is the option premium. So you gain the premium and you wait and see if the stock falls down to your strike price. And if it does, then you may be on the hook to buy the stock. Now, as we've all seen in the last few weeks, I'm sure some of you have sold put options on stocks that were at really high levels, and you were thinking to yourself, well, these stocks are never going to fall down to the level where I'm going to be obligated to buy it. And next thing you know, a few weeks later, the stock has not only come down to your level, but it's blown right through it. And a lot of people are now thinking, geez, do I want to buy this stock at this price now because it's already blasted down below it? And we're in a very unusual situation right now where the combination of when the oil market took a nosedive, when Saudi Arabia and Russia could not agree on the OPEC output quota, and then all of a sudden the coronavirus just really took hold. So everything just kind of snowballed on itself, and everyone was selling, and as we all know, everything came crashing down up until about 2 days ago. And everyone was just worried about, what am I going to do? I have all these put options that I've sold, and all these stocks are blowing through the strike prices at the same time. And either I don't have enough money right now to pay for it if I get assigned, or I have to put up more margin money. And that kind of snowballs on itself. And then everybody's selling other things to meet their margin calls. And that's probably why you saw the price of gold and silver go down over the last couple of days, because people had to sell other investments to meet their margin calls. So what we do in our newsletter, when a stock gets very close to or falls below the strike price, at one point a long time ago, we thought, hey, it would be a great place to buy this stock. But now that the stock has gotten very close to that level, what we do is roll the option. And by rolling the option, that means we will buy back the current put option that we sold, and we will resell a new put option at a lower strike price at a farther out expiration date. Now, what that does for you, and typically we would like to do that for a credit. So whatever price we buy the option back for, we need to sell the new option for at least that same price. So you're doing it for even money or a credit. That way you can stay in the trade for at least the original credit that you took in when you sold the original put option. And now you've rolled it down to a lower strike price. You've actually lowered your buy-in cost, your potential buy-in cost, if the stock keeps falling. So the main reason to roll the option is a defensive trade to help you lower your potential cost basis in the stock. So if you sold a $50 put option and you needed to roll it, you can roll it down to the 45 strike put option, which saves you $5 of a potential buy-in price. And if you did that trade for even money or a credit, you still have money that you've taken in from the original trade. And then you take it from there. Now, there are some people that will just hold it forever, and that if they get assigned and they're comfortable with the stock, we know we're in a very unique situation here. The market will rally again. So some people will hold it and take the heat for a while, knowing that the market will come back. In our service, we have a stop loss beyond that level, that if the market really, really tanks, then we get knocked out of the trade, and that's unfortunate. But you have to preserve your cash as best you can. And unfortunately, taking losses sometimes is part of the game. But in this situation where everything's just been so completely oversold, and we saw the last 3 days, the market has rallied back up 20%. I mean, how often do you get a rally of 20% in just 3 days' time? So that's why you get these really sharp rebounds after a really sharp fall. And it's really hard to trade in those environments because it's all the big money that's really controlling the markets. I mean, little guys like us, all we have to do is just sit back and watch and see what these guys are doing, because they'll just railroad you on the way down and they will railroad you on the way up. So you really have to be sure of yourself in the stocks that you pick, right? You have to choose very high quality companies that have been around a long time, that have a business that can thrive in any market environment, and just know that even if it goes down for a while, it's going to bounce at some point. So you might take some heat for a little bit, but you can't. It's hard to try to time these markets because they fall so hard so fast, and when they bounce so hard and so fast that you can't. How do you get in on a game like that? So you just have to kind of grin and bear it for a little while and know that you've picked a quality stock, and you're in for the good times and you're in for the bad times. And if you want to play in this game, you have to be aware of drawdowns and your emotions, and how are you going to handle a move that's against you, because we've been so used to this market going up for the last 10 years that everyone thought that this is just how it is and it's never going to change. And then out of the blue, within a matter of 3 weeks' time, we've gone from all-time new highs to down moves that we haven't seen since the Great Depression in the 1930s. And it's hard for a lot of people because they don't know how to handle situations like that. And we're all stuck like deer in headlights. We don't know what to do with ourselves. And most of the time you just end up doing nothing, which turns out probably to be the best thing you could do, because the market will bounce back and you're like, okay, you just kind of wish you fell asleep for a month, right? And you missed all the action and you woke up and the market's back up where it was. So sometimes sitting on your hands and doing nothing is the best course of action.
I don't know, Leigh. I wish I did implemented some stop losses.
Well, as a trader like I am, and it's hard to stay away from the action because that's my business, and I watch these markets all day long. And I should take my own advice sometimes and sit on my hands. But sometimes I see opportunities out there that are gone in an instant, and I know how to catch some of those opportunities, and I don't like to give up on that. So I will always be trading and racking up my commissions, and so it's just habit for me. 30 years, it's kind of hard to break at this point, but so that's that.
So let's just take a second I wanted to show everyone your newsletter. Let's hope this goes well. I don't show anything too funky.
Bring it up. Let's see what you have.
So it looks like your email, right, Leigh?
Yes, that's it.
Yeah, so Leigh, how many do you think you sent this week already? Four emails already this week?
This is probably the third one this week. Yeah.
All right. So Leigh's I'm a paid subscriber of Leigh's newsletter, and I should have done a bit of an intro. So Leigh's been coaching and mentoring me for quite a few weeks now. It's been a blessing, and it's been very helpful. And I love the newsletter because, especially like using Kellogg, for example, you in this specific email, so you already had Kellogg's as a naked put in your portfolio, and then you gave really explicit, very easy to understand details, dollar for dollar, buy to close, extremely explicit, very inclusive language on how to actually do a transaction, how to roll a put. In this case, it's how to roll a put. And also, of course, you're being humble and that you're being very transparent on the terms of the trade, and also when you've hit your stop losses and have to exit.
Yeah, these are, the newsletter is, I always knew that if I was going to write a newsletter, it had to be the type where people who've never traded an option before can really latch onto it rather quickly. Uh, I knew when I first started out, I didn't understand anything about trading options. And when I first walked onto the trading floor and I heard everybody screaming and yelling and calling out all these different numbers and using these hand signals, and I said to myself, there's no way I'm going to be able to understand what these guys are doing. I mean, it was unbelievable. If any of you have ever walked onto a commodity or a stock trading floor and you see the guys waving their arms and yelling and screaming, there's no way to understand what they're doing until you're actually there and someone's showing you what to do. And this is what they're talking about. And over time, I understood, and it was like a second language to me. And it's and I knew that writing a newsletter, I had to take the time to make everybody understand and feel comfortable with what we're doing, because otherwise you're just going to throw your hands up and say, I don't get it. I don't need this. So I know the language that needs to be spoken, and I know how to write that language out in text so people understand what they're doing. I think for some people, if they actually wanted to read the instructions right to their broker over the phone, they could do that as well, and the broker would understand what's going on. And also, there is some option jargon that you need to know to place some of these trades. Buy to open, sell to close. Those are things you need to know. Good till cancel, day only orders. These are things that you need to know. And so I try to spell it out as easily and as not uncomplicated as possible. And I'm also accessible. People write in and I answer their questions. And this is one of the things that people, I think, enjoy most about myself and the newsletter, is that I'm available and I'm accessible and I can answer their questions. So
yeah, you even got on a Zoom call to answer my question.
I don't like to leave people hanging. I don't like to leave people feeling like they can't do this, because you can do it. And I try to make it as easy as possible. But the market is crazy, and we've had a good bounce over these last couple of days, and I think the big question everyone has now is this the bottom? Are we done? Can we get back into long positions and just ride it all the way back up again? And I don't think that we are there yet. We've had a good bounce, which typically follows a move like this, and I think we will get a little bit more backtracking, a little bit more selling to go through, only because we still don't know the extent of the coronavirus. And we have earnings coming up over the next few weeks and the next few months. And we have no idea how hard some of these companies have been hit, and their earnings reports will show us. And if it really turns out to be bad, we will see some more selling. But sometimes the market prices in very worst case scenarios. So we may have hit bottom, but I truly don't believe we're there yet. And based on past price patterns of watching stocks all these years, I've seen these bounces back up. They go up for a couple of days, and then we get a little bit of sell off again, because people have bought in the bottom. They're taking some partial profits, and then there's no more bids, and so the market can cascade down again for a little bit. So we'll see. But I think that a lot of the damage has been done. Once you get a lot of that damage done, and you've had a lot of people that bought at the top have now sold out, those positions have been washed out, and we really should start to be making a base here, I think, over the next few weeks. So there's definitely hope. As long as this coronavirus can be contained, I think with all this social distancing, we're on the right track. And that's the only way to do it right now. You have to, as a good citizen on this earth, you really have to take into consideration what you can do to make this thing go away. And we all want that to happen. And so over the next few weeks, I really think we'll hit a point where the world will get a good handle on where we stand as far as beating this virus. And then once people feel okay, that's when they start buying this market back up. So I'm looking out towards probably, end of April, middle of April, and should be a pretty good handle on where we sit from there.
End of April, eh? So here's a shameless promotion. Leigh is our lead instructor for the all brand new Stock Hacker Academy version 2.0. That'll be the weekend of April 25th and 26th all day. We're going to maintain social distancing, so this will be live streamed. It'll be a very nominal cost for anyone who's already done the Stock Hacker Academy. Like tonight is our cherry and my treat to you all to bring you Leigh tonight, because I know a lot of people are worried about what's going on in the market. I've taken losses. Anyone who's been in the market, I'm sure, has taken some losses. But Leigh, is this the end? Is this the end of the free world?
Well, here, I'll share my screen, Erwin.
Oh, hang on. I think I have to make you something.
If you allow me to share the screen, I can go over some charts and give everybody a bird's eye look at what I see.
Oh, Leigh, so just quickly, this isn't, what kind of chart is this? What's it called? Because I use candles, for example, so mine are all green and red.
Right. I'm not a candlestick person, but this application that I use is eSignal. Mm-hmm. eSignal is a charting and quoting platform that's been around a very long time. It's a subscription based. You subscribe to whatever stock and commodity exchanges you want for real time. Some are delayed. But this is what I use to look at my charts. There's a lot of different charting packages out there, but eSignal is what I use and have been using for at least 20 years now, maybe longer than that, 25 years even. So what we're seeing here is, and I'll bring up the full chart. So can you can all see? Everybody can see this? Okay. So here we are right now, where this is actually the futures market. This is the E-mini S&P 500 futures as it is trading right now. They trade pretty much around the clock. We're up a little bit, I think, on the night so far. Yeah, just a little bit. And let me pull up the SPY. The SPY is the exchange traded fund based off the S&P 500. And my chart's still loading up here for a second. Let's see. Okay, here we go. So what we can see is and I'm sure everybody knows this, back on February 19th, this is what we've been doing, cascading down. And then the last few days, we've had the bounce up. Now, what we're seeing here, this blue line that I have is the 20-day moving average. Now, typically, I think the next point of resistance is if the market, S&P 500, can get up to about the 265, 267 level is where we're going to see that resistance met pretty hard. And if it can't blast through there, then we'll probably have a little setback. With the lows, we're about 218 on the S&P 500. And so I don't know if we'll go back down that far, but we will hit some resistance up around 265, 267, and then we'll probably start ticking back down here. So we'll see how that plays out over the next couple sessions or next week or two. What I like to do is I also look at the options chains. This might be a little bit hard for some people to see, but this is how I check the options. I got call options on the left, put options on the right. And as we know, we are sellers of put options. So I'm always looking at the right side of my screen. What we see here is these are options on the SPY. Right here in the middle is the months and the year of whatever options you may want to look at. So we have March 2020, and a little bit farther down, we have April 2020, and these include the weekly options as well. So I know there's a lot of players out there that like to sell put options on crazy volatile stocks like Tesla.
Please, no one trade Tesla.
I will show you what I did today just for fun. Now, there are some things that as traders we like to do for fun. Now, if you can see here, these are the June 2020 options. Tesla at $5 a share. Now, Tesla is currently at $528.16. That's where it closed at the end of today. Option strikes are listed from all the way up to $1,800 for Tesla, all the way down. Here's $5. Okay, if you're interested in potentially buying Tesla at $5 a share, these put options are trading. I sold a Tesla $5 put for 7 cents a contract today. Okay, now I know that's not a lot of money. I got $7 for selling this put option, but it's allowing me to potentially buy 100 shares of Tesla at $5 a share, right? So, these are some things that traders like myself like to look at every once in a while because, okay, yeah, I'm making a line in the sand. I will buy Tesla for $5 a share if it drops all the way down from $528 by the third week of June. Okay, that's just me. I'll be willing to pay $500 for my 100 shares times $5 a share is $500. I'm willing to pay that, and so someone gave me $7 today for my obligation to buy Tesla for $5 a share. So those are just some things that are available and out there now. I'm not telling anybody to do this trade. These are all hypotheticals and examples only. These are not real recommendations, but there's trades like that do exist out there in the world. So just for fun, and I do this for fun every once in a while, and keep my investments $500 that I can certainly on the line if I need to, but I don't want to tell anybody to trade with money that they cannot afford to lose. That's not what we want to do. So what we're looking at here, and I can pull up a chart of the Dow Industrials, and that has also rallied back about 20% in just a couple days worth. I mean, it's amazing how fast. These are called V-shaped bounces because it makes a shape like a V, and it happens once a stock or once the market drops really, 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 really hard like that, you'll get these V bounces. And it's hard to play these because when we're trading down here, when we're trading all the way down here, you think the world's coming to an end. You think it could keep going lower. And then just out of nowhere, it bounces, right? And that's just the really smart, intelligent money saying, okay, we've had enough. It's time to buy. And they buy it up tremendously, and they do it without your participation. And it's hard to get on board because it just moves so quickly, and you're just sitting there like, what the heck's just happened? And all you can do is just watch. And if you've been long, you're actually happy that these guys have, stepped in and bought, because it makes you feel a lot better. It takes the tension off a little bit, and you can get a clear mind again. Because I know as this thing was falling, we're all getting emotional, and it's hard to keep your emotions in check. And you think about all the money you may be losing, and that's really all you can think about. And then, like I said, out of nowhere, you get these V-shaped bounces. Now, we are coming on resistance of the 20-day moving average, so we will probably bump up against it. And if it doesn't blast through it, we'll probably get the tick back down a little bit. So that's what I'm looking for in the next week or so. And this is the chart. This is the type of charts that I use. I have 3 moving averages that I look at all the time. I've got the 20-day, which is the blue line. I've got the 50-day, which is the red line here. And the 200-day moving average is this, green or orange, whatever color that is, I can't tell. And it's a smoother line because it takes 200 days worth of trading into account. So that's why the 200-day moving average is a lot smoother. And so that's how I look at the charts. Down here, I have the RSI indicator. The RSI indicator is an overbought, oversold indicator, and it's based on 14 days worth of information. The RSI, the settings are over here at 14 days based on closing prices. That's the little C that you see in there. And I have the level set at 80. The 80 level is overbought, and the 20 level is oversold. And if it hits one of those levels, it doesn't necessarily mean it's about to turn, because as you can see, it went down below 20 points here. But if you look where that level was here, and so it kept dropping. So this is not necessarily an indicator that tells you it's going to turn. The market's going to turn immediately once it gets down here. You don't want to do that. You want to wait until you see the oversold, and then you have to wait for the market to make a move, and you'll see now it's starting to move back up. Same on the upside. Here we're getting into some overbought levels here, but look, the market kept going up. So it's more of a just an indicator that tells me, hey, we're getting on some extreme levels, but it's not necessarily the turning point. It may be near the turning point, but not the turning point. So take it with a grain of salt. But it's helped me over the years see some of these turning points that happen a little while later. And that's really all that I do. I have a number of stocks that I watch over here on a daily basis. These are stocks that I like to watch. And then it helps me decide if we're going to sell put options on them. So it's really just having a watch list, quality S&P 500 stocks, and then we decide whether to sell some put options. Now, during
Sorry,
times
Leigh,
like,
are you
yes,
in the last few days, have you been looking to, or even what's your strategy for the next few weeks? Are you still writing naked puts? Are you trying to get assigned, and are you even buying shares?
Well, we have a number of positions open right now, a number of put options that we've sold that are either in that we've rolled, or the stocks have come down below the stock price, the strike price, and have bounced back up above it at the moment. So we're still holding right now. We're waiting to see if we will get a sign on anything. And like I said, if the stock gets a little bit close to the strike price, we'll roll it. We'll roll it to take our risk in the trade down a little bit. So we're just waiting to see what happens. As it is now, most of our readers, they would rather just collect the cash from selling the put options than having to buy the stock, because as we know, if you buy stock, it costs a large amount of money that you have to lay out. And a lot of people don't have all that money to lay out all at once. So they would rather not get assigned. They would rather just sell the put options, collect the cash, and move on to the next trade. So that's pretty much how I like to try to run the newsletter. But in certain situations like this scenario that we've never been through before, that I cannot guarantee that we won't get assigned. We may get assigned, and then if we do, we buy the stock, and then we start selling covered calls at that point to bring in more cash. And then if we sell the covered calls and those expire worthless, and the stock keeps going up, we'll sell some more calls and we'll gain the appreciation on the stock move itself. So
Leigh,
we're in a holding pattern right now.
When you get assigned a stock and say you've lost money on the stock, are you writing calls? Are you rolling them in order to not get called, to have the stock called away, or are you just trying to get the income and then?
Well, if you get a sign on a stock and you want to sell covered calls, you don't want to sell a covered call at a strike price that it's going to give you an overall loser if you get called away on the stock, right? So let's say you sold a $50 put option and you get a sign because the stock has fallen down to $30 a share, right? So now you've got a $20 paper loss on that stock right now. It would do you no good to sell a 35 strike call option, because if the stock ticks back up above $35, you're going to have to sell your stock at $35 after you bought it at $50. And
Leigh,
even though
would you mind showing us a recent example that you've had to write calls on?
have not done that.
Oh, haven't been assigned yet. Okay, good for Leigh.
We have not reached that point yet. But what I'm saying is that if we did get a sign on a stock, we have to write a call option at a strike price that will at least give us an opportunity to make money on the trade overall. So you don't want to sell a covered call at a strike price below your total break even on the trade. So there may be a time if the stock has fallen really, really far, there may not be any opportunities for you to write any covered calls at that point, because it just won't be worth it. So you may have to just sit it out for a little bit until the stock actually ticks back up, and to a point where then you can start selling covered calls. So this is a different scenario for a lot of people. A lot of people have not been in this situation before. This is one that I've never seen before in all the years that I've been trading. It's come on so hard and so fast But it's encouraging that we've seen this move back up the last couple of days. And I think, like I said, we may get ticking down here over the next few weeks. But once that bottom is formed and once the virus has been contained, there's no way for this market to go but up again. And that could be in a few months' time. So you just have to kind of hold yourself and just realize, okay, I bought some good stocks, and the stock market has gone up over time, right? You have to go with the history here. Okay, this is the Dow Jones Industrial Average since the early 1980s, and here's from 2009 when we hit the bottom 11 years ago, and this is where we went. I mean, there's got to be some profit taking at some point. This was a little bit more than I think we all had anticipated, but the market will go back up. It will go back up over time because businesses will get back into business and they will become profitable again. And if you want to make money in the long run, you have to be invested in stocks. That's how it is. And unfortunately, there will be pullbacks from time to time. This one has been extreme. But like I said, if you are getting involved in quality stocks and you're willing to hold, and you have the time to hold, years, we're talking 3, 5, 10 years, you will end up making money. I mean, most people in 2008, 2009 thought everything was going to go to crap. And it did for a while, and everyone was scared down here. And when you get to that extreme fear, that's exactly when the buying starts. And then it only took a couple years to get back to where we were before the drop. And look where we've gone since then. So we've got this drop, may come down a little bit more, but it's just going to go back up. So you have to go with the history. You have to have faith in the global economy that companies will survive and they will thrive. And you have to believe in the system. And that's how you do it. That's how you grow your money over the long term.
Leigh, so some people have been asking about the newsletter. So FYI, anyone who is buying the new course will get 1-year subscription to Leigh's newsletter as well. So you don't have to go out there and buy it right now. If you haven't taken the course before and you are buying the course, you will get 12-month subscription to Leigh's newsletter. And again, for anyone who's taken the course before with me, so with me as in like you bought the course from me, then it'll be a very nominal charge and to take the course again, which will be the weekend of the 25th, 26th, and then also 8 lecture-based webinars by Leigh once a week over 8 weeks. The nominal charge, and we're going to give it all to a COVID-19 related charity. Cool. And Leigh, something that you told me in one of our coaching sessions, what is the highest price stock that you'll write a naked put on? What's the dollar level?
Oh, that's a good question.
Is Apple good? Amazon says 1700. What is it at now? Sure.
It all depends on how I'm feeling about the stock. I mean, Apple. Let's see. Let's take Disney for example. I'll show you something that I've done with Disney. Here's a chart of Disney. It's at $105 a share now. When Disney was probably trading at $120 a share, I sold the $55 puts on Disney, right? So what I do is I go back, I pull up a monthly chart so I can get a long-term perspective. And last time Disney was at $55 a share was sometime in 2013. Okay, when Disney's up around $120, it already had a good pullback, $30.
Sorry, Leigh, you want to show your screen again? I think it will help people if they follow along the chart.
I'm sorry, I forgot to hit the screen share. Stay with me a second. Okay, everyone seeing the chart?
Yep.
Okay. So here's a chart of Disney, a monthly chart of Disney. So you can see the long-term trajectory. Disney was hitting highs of over $150 a share. When it dropped down to about $120 a share, maybe $110, I decided, okay, I thought that the move had ended. This is before things really started to get bad. It was bumping up against the 50-day moving average. I thought we'd have support right around $110. So I sold the $55 puts, thinking, Disney has not been at $55 a share since early 2013. And I would be comfortable buying Disney at that price. That was my line in the sand. I said, okay, if Disney falls that far, I'm willing to buy it because I know Disney. I lived in Orlando for a number of years. I know the tentacles that Disney has over the whole economy of Florida, that it's not going out of business. It's making so much money that if I could buy it at $55 a share, a third off from where it was, I'd be pretty happy. Now, when it dropped really hard recently, I decided to roll the trade for myself. I had sold the June 55 puts on Disney, and when it started crapping out a little bit farther, I rolled it down to the $45 puts, which means now my buy-in level could potentially be $45 a share. So $45 a share, it hasn't been there since middle of 2012. So I just knocked $10 off my potential purchase price on Disney. And so I'm waiting to see that. That's, I think, the expiration date is October. So now I have to wait it out until October. But, for $45 a share, I'm willing to wait. What's
So
the
Leigh,
highest price?
To add to that, at what price point would you be doing credit spreads?
Well, we talk about credit spreads. Is everyone familiar with credit spreads?
If they don't, they should be. It's in your book.
Credit spreads are when we when we sell a put option at a high strike price and then buy a lower strike price as a protection against it. That offers you a limited risk, limited reward opportunity.
I have a credit spread on Zoom right now.
So you sold put spread.
Yeah, but I sold the put spread on Zoom, what we're using right now.
Yeah, well, that's good. That's good. I mean, it's limited risk, limited reward. You have to pick a point where you think the stock will not fall to. Let's take a look at Boeing for a second because this will help some people understand what we're doing here. If you look at Boeing back, this was on February 5th. Boeing's at $329 a share. Is everyone able to see what's going on here? Boeing's at $329 a share. And you're thinking to yourself, geez, I'd love to buy Boeing at $200 a share. I mean, it's at $329. That's $129 cushion. And you're thinking to yourself, there's no way Boeing's going to fall from $329 down to $200. Well, as we start ticking down the days, you see Boeing dropping all the way down below $100 a share. And now you're like, holy crap, what just happened? I'm obligated to buy Boeing at $200 a share, and it's already down $100 more than that. So these are things that you definitely want to take into consideration before you sell a put option, because stocks can move a lot further than you ever thought possible. And in a situation like this, it's happening in almost every sector, in the cruise lines, in the airlines. There's no guarantees in trading, but look what's happened to Boeing. Okay, so now look at that move, bang, right? There's that V-shaped recovery right there. So it's gone from $90 all the way up to $180. It's doubled in price in a matter of a couple of days. So now you're at, if your purchase price was $200, now you're only $20 below that. So you take the bad with the good, and that's some of the risks in trading. I have no doubt that Boeing will be bouncing back again over the ensuing months. It's just whether you can take some of the heat for a while. Personally, selling a $200 strike option was would be a little bit too high for me. I'd probably like to stick to strike prices at $50 or lower, because I think it's a little bit easier on the wallet to say, okay, well, I'll spend $5,000 versus $20,000 in the case of Boeing. Like I said, in the case of Tesla,
$5 on Taste of Tesla.
$5, right? Erwin and I had talked about Ford the other day.
Yes, please.
Right, here's Ford.
We should have bought it when we were talking about it.
Erwin and I were talking last week about Ford, and I had written in the newsletter about Ford. You could sell not only the $1 strike prices, but you can sell the 50-cent strike prices on Ford. Okay? I've been selling $1 puts and 50-cent puts on Ford, meaning if Ford falls all the way down here, I'm buying Ford for 50 cents a share. These are just some of the things that are actually out there that you can do when you sell put option. Now, would I buy Ford for 50 cents a share? Of course I'd buy Ford for 50 cents a share because I know the government will bail them out if the auto industry falls like that again. So I really don't have a lot at risk. Now, Ford's most likely not going to fall to $1 per share in the next 2 months or so. So what happens in that case? Well, I just walk away with the put option money that I sold and I move on to the next trade. The good thing about what's happening now is that when volatility is high, I'm sure a lot of people are familiar with the VIX, right? The VIX, VIX for VIX is the volatility and fear indicator of the S&P 500. And now what it tells you is not only does it tell you how much fear is in the market, but it also tells you how expensive options prices are getting. For some of you that may know, an options price is made up of a couple different factors. One of them is where the stock trades. One of them is how much time is until expiration. And the third major factor is what is the volatility doing in the market? And volatility is a determinant of the options price. And when volatility skyrockets like this, the price of the options will skyrocket as well. Doesn't matter if the stock's moving up or down, the option price will go up as well. And what we're seeing here is, let's move out to a monthly chart. Here's 2008, 2009 financial disaster. The VIX hit somewhere in the 90s intraday. Here we've gone up to about 85 intraday. Options are trading at such high levels now that that's why we can sell Ford for 50 cents. The 50-cent put options, why we can sell Tesla at a $5 put option, because when volatility spikes, that means people are clamoring to buy put options for protection. They're doing anything they can to buy put options because they need the downside protection, and they're paying ridiculous prices for that protection. So as option sellers like we are, we sometimes like when volatility spikes like that, because it means we can sell these just ridiculous put options. But at the same time, for positions that you already hold, a rising volatility like this will increase your paper losses a lot faster than you're used to. So it's good and bad, right? If you have no positions on and you all of a sudden wake up and here's volatility, you're like, wow, I could sell all these great put options at great prices. But if you sold put options when volatility was way cheap down here, you're not feeling so good. So once again, you take the good with the bad. You may have to take a little heat sometimes, but as long as you know that you're comfortable buying that stock at that particular price, and it really doesn't matter. I always tell my readers that you never sell a put option. You never sell a put option on a stock that you don't want to own, because you may end up buying it at some point. So, just remember that.
Sorry, Leigh, do you mind if I take some questions?
Sure, absolutely.
Okay, Brian, you're good to unmute. Brian Zamet, please, can you unmute yourself? Because I don't understand what you're writing.
Hey guys.
Hi, Brian. Have you read Leigh's book?
Sure have.
Go ahead, Brian.
So I've got a quick question about position sizing. I'm trying to figure out the kind of ideal position sizing, like as a percentage. Like, are you looking at every trade being basically the same size dollar-wise, as a percentage of like net lick or excess liquidation value, or something else?
It's a good question. Everybody has a different threshold for how much money they would like to put into the trade. Everyone has different account sizes. It's I can't really, I have to have some kind of level where I have to make a trade recommendation, just thinking everybody has an opportunity to buy this stock if we get assigned. I can't tell you how much you should put into each trade. I don't know what your account value is. I don't know what size you like to play with. The best thing that I always tell my readers is that if this particular stock is a stock that you would be comfortable owning at this particular strike price, that you put in as much or as little as you deem necessary for your own portfolio and risk parameters. I don't have any guidelines for how much you should put into each trade. I don't have that information. Of course, you don't want to bet at all, but you want to have enough free cash to play the position. We have guys or gals in our newsletter that will sell one contract only of every trade that I recommend, or they'll do 10 or 20 or 50 or 100. It all depends on their size. So I don't have a ballpark figure for you to tell you how much money you should play with for your account value. I just know that you have to make that decision on your own, that if you're willing to buy this stock, make sure you're okay with that and only play with the amount of shares that you would be okay owning. And over time, people will, they'll start with one contract and they'll just bump it up from there and just base it on, where they are at that point in time in their own financial situation.
Leigh, are you actually interested in owning the shares of anything?
I am. I mean, I think because stocks that we're looking to buy are actually, I think, quality stocks. We know over time they're going to go up, and a lot of them will pay dividends as well. So we actually own the stock, we'll get the dividends, which helps pad the account. But once again, we always start with a huge cushion. When we sell a put option, we hope for at least a 20 to 30% cushion below the current price of the stock. Most of the time, we don't get assigned, and we just collect the income. And that's a way my readers have always told me that they would rather just sell the put option. They don't want to buy the stock because they don't have all that cash available. And they don't want to get into a situation where they have to decide, I can't do all of Leigh's trades because I don't have enough free cash. So they would rather just sell the put option and not purchase the stock. But I can't guarantee that it won't happen. And everyone needs to be aware of what their financial and cash situation is if we get assigned. I do everything I can to avoid that by rolling the options. We do that first. We do that as many times as it is possible to do. And then we just go from there. I mean, if we roll a trade a couple times and we're just at a point where, this stock would be a great point to buy it, then we just wait and see what happens. So.
Leigh, speaking of being capital efficient, when it's time to go long, would you be doing deep in the money calls, for example?
Right. If we decide to take on that position where we say, okay, well, let's just say we wanted to buy Disney, right? If Disney got back down to $85 a share, we said, okay, you know what? We think the bottom is here. We want to buy shares of Disney. Now, you can either just buy the shares outright. You can buy as many shares that you're comfortable with, but we like to do the deep in the money call option. We buy deep in the money call options if we want to take a position in the stock without actually buying the shares. And that'll usually save you 50% off the price of the stock or the cash outlay to buy the stock. By buying a deep in the money call option, you can save at least 50% of cash. But you have to know that you're buying it at that current stock price. Even though you're saving 50%, you're still buying it at its current price. So you have to be very sure of yourself that the stock is going to go up at that point. You have to set your stop losses. But yes, if we were a option buying service, that's what we would be doing. We would be buying deep in the money call. That's the only, as I've written in the book, that's the only option buying strategy that I recommend if you want to get long the stock. Now, if you don't have any desire possibly purchasing 100 shares of stock, because buying a deep in the money call option, you may get an exercise, but you don't have to exercise. You can actually sell it out and purchase another another deep in the money call when it gets close to expiration. But if you don't want to play with a potential 100 shares, then you could just purchase the shares outright. You can buy yourself 10 shares, 20 shares, whatever your account can handle at that time. But yes,
for anyone who doesn't know what Leigh's talking about, it'll be taught in the course. I've requested that Leigh teach it. So it'd be a good timing actually, end of April, to know how to buy deep in the money call. But for those who know what I'm talking about, then it's a good tool to have in your toolbox. I have some deep in the money calls right now. It's not going well for me right now, but hopefully it'll turn around.
Look at it's your risk is contained to at least 50% of what it would cost to buy 100 shares of stock. And if you buy long term, 9 months to a year out, then you've got a lot of time for the stock to turn around. So it's a good strategy if you're looking to go long a stock. It's a good strategy.
David Pereira asks, do you roll credit spreads?
We can. We have not yet. We do have another credit spread newsletter that we have not rolled any credit spreads at this point. We closed a couple out, but we have not rolled any. You certainly could do that. It's the same as rolling a naked put. You can roll a credit spread. It certainly can be done.
So I have some people commenting that you're so far out of the money, but you're just for example, for the newsletter, you're just saying you're trying to teach the most conservative method possible, really.
Right. There are some people that will sell put options using an at the money strike price, which is the strike price that's nearest to the current stock price. And that also pays a lot more money. My goal is to, number one, have a lot of cushion between the current stock price and the strike price. Because as we're seeing, stocks can fall, and they can fall very far. So what we like to do is have a lot of cushion. We usually start with 20 to 30% cushion below the stock price is where we sell the strike price, 20 to 30% cushion. Because if we have to buy the stock, we want to buy it at a huge discount. And even what we see now is that 20, 30% has been blasted through by a lot of stocks, right? It's gone right through it. And a lot of people that sold at the money put options are in a world of hurt right now because the stock has moved very far. I've always been in the camp where I want to bargain. I want to get this stock on sale. And the only way to get that stock on sale is to sell a put option at a strike price at whatever percentage off that you'd like to get. Our sweet spot has always been in that 20 to 30% range. And when you go that far out of the money, the payout is going to be a lot less. So you take the good with the bad. You have to weigh, what's more important to you? Is safety more important in the amount of cushion you get, or is the amount of money you get when you sell the put option more important? Now, over the last 10 years, when everything's going up, selling at the money put options usually worked because the stocks just kept going up. But in just the last 3 weeks alone, we've given back 3 years worth of gains in a matter of 2 or 3 weeks. So it's a very scary and unique situation. I think a lot of put sellers who've been lulled into complacency over the last few years or 10 years now see what can happen. So for us, we always err on the side of caution. We always want to sell put options with a lot of cushion to begin with. And we get less money for it, but that's just how we play it. And it also keeps us from buying the stock. It keeps us from getting a sign a majority of the time. And that's how we do it. There's others out there that probably have different systems than me. They probably sell put options at the money strike prices because they think the stock has bottomed and it's going to go back up. I always start with a large cushion, and that's how we play it. Now, I always tell my readers that, look, if you don't like the strike price that I've chosen, but you are okay with the stock itself, then pick a strike price that meets your risk parameters. If you don't want to sell a put option at a 20% below the stock price, then sell it 10% below or 5% below, whatever floats your boat, and then you manage that position on your own. And we have readers that do that, and they write to me and say, I didn't sell that put option you recommended. I sold a different strike because I felt that the stock was bottoming, or I'm okay with buying it at that price. That was my risk. So that's fine. People will always tell me, I wanted to get more money out of this put option, so I sold a different strike price than the one you recommended, and that's fine. That's fine. I'm here to offer guidance and just kind of give you ideas of what is the most conservative way to trade this stock with these put options. And if you want to take on a little more risk, more power to you. So I have no problem with that.
The way I envision how Stock Hacker Academy version 2.0 will operate, it's like driving school. What did you learn in driving school? You got on the highway on the on-ramp, you drove in the right lane. We're not here to pass people. We're not here to street race. We're here to be defensive. And then from there on, I know a lot of you will do your street racing, but within the class, we will teach you how to drive in the right lane.
Right. I mean, when people first sign up for the newsletter and they may not have a lot of experience with selling put options, I want them to be as safe and as comfortable from the get-go, so they're not scared off right off the bat. Right? You need to take baby steps, and the way to take baby steps is to sell very deep out of the money strike prices, and you get a little bit of money, you take in the premium, and you get to see how things change over time. You get to see how the option starts to decay over the ensuing months, and it goes from whatever we sold it for, and it starts to decay. And then when we buy the option back to lock in the gains, people understand, okay, now I understand. So when I sell this put option, the stock moves up, the put option price moves down, we buy it back, we lock in the gain. Okay, so I'm starting to understand how this thing works. Now, if we were selling at the money put options right off the bat, and the stock's really volatile, and the option price is all over the place, it's going to scare a lot of people, and that's not how you want to start something new. It's just like you used in the driving scenario. You're not going to throw somebody right in the middle of a 5-lane highway where everyone's driving 80 miles per hour. That's going to be a disaster. And that's not what we want to do when we first learn how to sell put options, or anything for that matter. You want to take baby steps. You want to be as conservative as you can. And then once you got a handle on what we're doing, then you move over to the left lane and get a little bit more risky, or sell strike prices that are not as deep out of the money. And then you go from there. And everyone has their different thresholds. Everyone has their own comfort levels. And I'm just here to guide you on how to do this properly. And then you can take it to as risky or as less risky as you'd like.
All right. Thank you, Leigh. Again, folks, this isn't supposed to be an intro course. This isn't remember, a lot of people who took the course didn't know what a call or a put was. They didn't know what the stock market, how it operated. They never bought a stock before, so that's kind of where we're trying to. We have to accommodate those people, and I know there's a lot of people who like to go, who will drive in the fast lane, but a lot of the analysis that Leigh will teach, it still will help you make your decisions if you want to ramp up the risk level. Like, admittedly, I do things much closer to the money. So Nick DiTommaso has a question. Nick, you're gonna mute yourself and ask yourself. Nick, you still here? Or did you fall asleep? I know he's a get up early.
Sorry, I had to mute myself.
Thanks. Hey, Nick.
I have to remember what I actually asked.
What are you chirping me for?
I thought you would read my question. Anyway, my question was along the lines of, considering the volatility of the market today, if you have a long-term investment horizon, what would you recommend? Should you be looking at the short-term premiums, but potentially miss out on long-term gains when the market goes up? Or should you lock in for the long term now because prices are so low?
Yeah, that's a great question. So the farther out you'll get more money for the put option when you sell it, right? More time equals more money. If you're really looking to get your hands on stock, so let's just say the stock's at 100 and you really think it's crapped out and it's bottomed out, and you think it's going to go back up, and you really want the stock, and if the stock doesn't go down anymore, you won't get assigned, you won't get to buy the shares, you'll keep the money from the put option that you sold, but you won't get to participate. One thing that people can do, and that is an idea that many of you may not have thought about is selling in the money put options, right? So if you sell a $150 strike put option while the stock's at 100, more than likely you will get assigned. You'll have to buy the stock at $150 a share, but you'll probably be selling that put option for $55 a contract, which effectively makes your purchase price $95 a share. And so let's just say the stock's at 100, you sold a $150 put option for $55 a contract, and the stock rallies up to $125 a share. You get assigned, right? So now you purchased your 100 shares, you've taken in all this premium, your purchase price is $95 a share, and now the stock's back up to $125 a share. So not only were you able to get assigned and buy the stock, you've already locked in $30 of profit at this point. So, if you think that the stock is bottomed out and you want to make sure that you are on board for the future run, then you need to make sure that you actually get assigned the shares, right? So if I'm understanding your question correctly, and the only way to do that is to make sure that you are assigned. And to be almost 100% sure of getting assigned is that you have to sell in the money put options, right? So because if you keep selling out of money put options, there's a good chance that you won't get assigned, and then you'll miss the run back up because you won't have purchased any shares. Is that pretty much the question you were asking?
It was. Thanks a lot, Leigh.
Okay. So selling deep in the money put options is something for another day, but people do that because they definitely want to get the shares, so they'll sell a deep in the money put option, which almost guarantees them being assigned, and their purchase prices will end up being a little bit lower than where they think the stock is bottomed out. So that's just another strategy that you can use.
Leigh, are you using margin? And then the Canadian question. Sorry, go ahead.
Yes, I sell put options in a margin account. And I think most people know that margin account will allow you to use less dollars. You have to put less dollars up to hold the position. Now, in a cash account or an IRA account, you have IRAs in Canada? Is that in the equivalent of the U.S. individual retirement accounts?
Kathleen, is ours RSP?
An IRA is like an RSP. A 401k is like a defined contribution, and then a TFSA is a Roth, I think.
I didn't know that one.
Okay. All right. So
thank you, Kathleen.
I'm sure some of the rules are the same there. In the States here, a retirement account, you are not allowed to use margin. We have some readers that sell put options in retirement accounts, meaning that they have to put up the full amount of the cost of the stock as if they were actually going to buy the stock. Now, I don't think that's an efficient way to use your money, because since you haven't bought the stock yet, why are you being told that you have to put up all the money as if you actually bought the stock already? It's not a good way to use your cash. So in a margin account, the brokers will allow you to put up just a fraction of the potential cost of buying the shares, which I think is a better way to spread your money around to other put options. Now, if it looks like the stock is dropping enough where you may actually end up having to buy the shares, your margin requirement is going to go up very close to what it's going to cost you to actually buy the shares. So when you hear the term margin call, or someone gets a margin call, that just means that the broker is telling you, hey, you need to come up with a little bit more free cash because it looks like you may end up having to buy this stock, right? And a lot of people will say, oh man, I'm losing money on this trade. I got a margin call. Well, it's not really what's happening. What's happening is that it's just getting closer to the fact that you may actually have to buy the stock. And when you buy a stock, you have to pay for it in full. So your broker's just coming back to you and saying, hey, look, it looks like you may have to buy this stock, so we need you to put up more money. So there are some people that will sell put options in a cash account, an IRA, and they know that, well, if I have to put up 100% of the cash right off the bat, then I already know how much I can play with. I know how much money I have, and I know how many contracts I can sell. When you sell put options in a margin account, sometimes you can kind of lose track of how much money I may have to put up if I have to actually buy the stock, and you end up selling too many contracts and you get caught in a cash crunch. So even though I think margin is a better way to use your cash, you still have to be cognizant of, well, what happens if the stocks fall and I'm going to have to buy all these stocks at the same time? Am I going to have enough cash to cover all the trades at the same time? And that's when you really start to look at how many contracts you sold. Okay, if I sold 3 contracts of each, that means I might have to buy 300 shares of each. Do I have enough cash to cover all those trades if I have to buy them all at the same time? Typically that won't happen, but I personally do trade with margin because it allows me to sell more put options, right? At the same time, I'm selling these way out of the money put options, which puts my risk at a lot less because I don't think the stocks are going to fall that far. But if the stocks start to fall, I have to make sure, geez, I really am sure that I would buy Tesla $5 or $4. So I'm okay with that. $250 a share, then I'm not so sure. That'd be a lot of money I'd have to come up with. So just know what you're playing with, know how many contracts you're selling, and know how much it would take if you actually had to buy the stock. But margin, readers, that if you do it in a margin account, you'll just be able to use your cash a little bit more efficiently. You won't have to put up the full 100% of the purchase price of the stock, even before you're actually knowing whether you actually have to buy the shares or not. I just don't think that it's right to have to pay for something when you actually haven't purchased it yet. That's just the way that I see it, if everyone could understand that.
Leigh, would your strategy change much? For example, us Canadians, we're only allowed 3 times margin versus you're allowed 5 or more, I believe you've told me before.
Okay, so ask the question again.
So in Canada, we're only allowed 3 times margin. Would your strategy change if you were Canadian?
Well, I think it would probably affect which strike price I can use and how much, if I couldn't do it, I'd have to put more cash into the account. It's hard to say, until I actually am in that situation and see how it affects my trading. Then I could answer the question. But as of now, I can't really answer that question.
We'll just lend you somebody's account. Anyone need some repair work done on their account? Excuse me. That's actually a great question. When you enter a trade, do you have a target return, or do you set targets or goals, like per month, per week, per trade?
No, I don't set a percentage return amount, because when we trade on margin, the margin amount is always dependent on the strike price that you choose. If you sell a $5 strike price, your margin is going to be a lot less. Your margin requirement is going to be a lot less than if you sold a 200 strike put option. The larger the strike price, the more margin requirement you will have. That's why we like to stick with stocks typically $50 and under, because the margin requirement is more manageable. Our goal is always to sell when our sweet spot is to sell put options about 20 to 30% below the strike price and about 2 to 5 months out in time. And typically we will always get the same amount of premium for selling that put option, no matter where the stock price is. If it's a $200 strike price or a $50 strike price, based on the parameters that we use, we always collect the same amount of premium for the put options. And that may be hard to understand at this point, because you think, well, it's a $200 stock, I should be getting a lot more for selling that strike price. But over all the years that I've been doing this strategy, number one, selling the put option 20 to 30% out of the money, 2 to 5 months out in time, will always give you this close to the same amount of premium, no matter the stock price. Okay, so we're looking at it at a dollar figure. We want to collect a certain dollar amount, and we're not looking at a percentage return. It's just you can't base selling options on a percentage return, only because the margin requirement is always based on a strike price, and that strike price will dictate how much money you have to put up. Now, if we collect, let's say, 50 cents per contract on a $10 stock, the return is going to be a lot higher, the percentage return, because your margin requirement will be very low. If you sell that same 50-cent contract on a $200 stock, you're going to have to put up a lot more margin requirement to sell that put option, and your percentage returns are going to be a lot lower. So I don't look at percentage returns as how successful we do. I always look at what's the dollar amount of the put option that we can bring in. and once again, whether I would be comfortable buying that stock at the specific strike price. Now, when you let's just say you're a stock buyer, right? You figure out your return on investment is always easy when you buy something, right? You buy it at one price, you sell it at another price, and there's your return. It's not, you cannot figure out a return when you're selling options in that regard, because the margin requirement will always be dependent on the strike price. So it's a little bit different kind of calculations for your return, your percentage returns when you sell options.
Leigh, some people are asking, what kind of money is Leigh making? I've heard your answer to this before, but I don't want to ever put words in your mouth, so I'll let you answer.
Well, I mean, I still put on. I have a portfolio myself. I have stocks that I own. I have retirement accounts. I'm in for the long haul. I mean, when you get to a certain age, I have a family. I have retirement goals. My goals are to be in the market for the long run. That means being long stocks. 20 years ago, 20, 30 years ago, as a trader, I was trading as a way to increase my income. I was taking on lots of risks. That's just how it is when you're younger. You take on more risks. As I've gotten older, gotten more conservative, I sell put options for a lot less money because I don't want to take on the huge risks anymore. So, I'm certainly not rolling in millions of dollars and billions of dollars. That's just not, that's not where I am. I can tell you that, but I have a decently comfortable life, and I'm here to help people, and I still trade, and I have my own portfolio, and I write these newsletters to help others, and that's where I'm at in life right now.
So Kathleen's asking if you wrote, do you still write 20% of the money when the VIX was 12? So for anyone who was in the last webinar, like Leigh gave examples where he was looking for, like damaged companies. Like we did the Cisco example, for example. Or is that a different call? Do you look for opportunity? You're not just blindly choosing anything that's out there.
Well, one thing that, before we hit this little patch here of all the selling, one of the things we like to do around earnings season, you get earnings every 3 months out of the year, and we always key in on if a quality stock has a bad earnings report, right? And if you have a bad earnings report, the stock is going to gap lower. And we would typically like when a stock gaps lower, a quality stock, because we know it's a one-time event. The bottom feeders are eventually going to come out and buy the stock back up. So even if volatility is low and options are trading for a lot less than they are right now, when a stock gaps lower because of a bad earnings call, that the volatility on that individual stock will skyrocket, and it'll push the option prices up, which is what we like to see, because that gives us an opportunity to sell these put options on this stock as it's having a temporary blip to the downside. And as we know, the stock will end up going back up, which makes us profit even faster when we sold those put options. So that's, even when the VIX was low, we still were able to sell put options, not as many as like now if you wanted to sell them, because there's so many more opportunities. So we had to pick and choose very carefully. When volatility is very low like that, you have to go a little bit further out in time to get a decent payout. So one way to combat the lower volatility is that you go further out in time. And if the stock gaps lower and the put options pop, that's another way to take advantage of a low volatility environment. So that's what we look for on more of a normal stock market, is when quality stocks have a one-off bad earnings report, and then we sell put options at that time. That's something we look for.
Sean Rosario, you want to unmute yourself and ask your question? From down under. Sean, you're not unmuted yet.
Oh,
there you are.
Can you hear me?
Hey Sean.
Hey.
G'day,
Hello,
mate.
sorry, I'm just making breakfast for the kiddies over here. We're homeschooling this week. Leigh, just a question regarding risk management. Stop losses. When do you consider employing them? I know rolling options is a favorite for you.
Right.
But anything with stops that you can talk about, or when you would consider using them.
Sure, we have a hard stop that if after rolling, however many times we can roll a trade, if the stock keeps ticking down 25% below the strike price, it's time to get out. It's time to get out. It's just basically the same as if you bought a stock and you set a 25% stop loss below your buy-in level. That's what we do. Typically, starting out with a 20 to 30% cushion is good. If we have to roll, then we roll. If we have to roll again, we roll again. We decide, okay, that's it. We're not rolling anymore. Then we just tack on a 25% stop loss level below the strike price at that point in time. So that typically means you're looking at the stock having to move, almost 50% from your original entry point, which is a quite a large move. Now, we've seen some of these travel stocks of late have fallen quite a bit, much more than 50%. So now whether the readers want to follow along with me on that, it's up to them. But yes, that's our end game right there, is 25% below the strike price after a roll or two.
No, thanks for sharing that, Leigh, because I know everyone has, different methodologies, or some people don't even employ stop losses or defining their risks, right? So it's good to hear that, you have, so it's a mental stop though for yourself, right? You would look at where the strike is and then say, hey, you know what? It's about 25%. Maybe it's time to take the loss. Is that
right.
your
yes,
kind of thinking?
That's exactly how it goes. Stop losses, most of the time, stop losses are to get you out at a loss. If you have a trailing stop loss, like let's just say the stock has gone up quite a bit, your 25% stop loss could still get you out at a profit, depending on how far the stock may have run over the course of time. But like I said, 25% below the strike price. And this is if the stock is moving down, we've rolled it a few times, then we decided, okay, that's it. We're putting in a 25% stop loss at whatever strike price we're left with at that time.
Fair enough.
Hope that helps.
Thanks
Sean.
for that, Leigh. Can I ask one more question, Erwin? Leigh? Yeah.
Sure.
Okay. One other question. When you're doing a credit spread and it goes against you, what happens? I just want to confirm what happens on expiration. Is it just the difference, the spread between the two strikes that you're going to lose on like behind the scenes? You get assigned and then it gets sold, or is it just the difference that comes out of your account?
If you're selling a put option credit spread on a stock, and the stock finishes in between the strike prices, you will get assigned on the short strike, which means you'll have to buy the shares, and the lower strike that you bought will expire worthless. So it'll end up being like being short a naked put option, where you will be assigned the shares and you'll have to pay for the shares, and come Monday morning, you'll have those shares in your account. If you don't want that to happen, then you have to make sure you get out of the trade before it expires. And that typically means buying the whole spread back, most likely for a loss at that point.
Okay, in the situation that it goes beyond that, that's in between, right? In the situation that it goes beyond that protective strike, then it's just the difference between the two?
Yeah, if it goes beyond it, if the stock falls below both strike prices, then the short strike will be assigned and the long strike will be automatically exercised for you. And you'll just end up taking the maximum loss on that spread. And the cash will be the cash loss will be realized in your account value come Monday morning or Saturday, whenever your broker does all the transactions for you. Yeah. So if the stock moves beyond both strike prices, both trades will just offset each other, and you'll end up taking the maximum loss on the trade.
Thanks, Lee. Appreciate that. Yeah, appreciate that. Thank you.
Okay.
David Pereira, you want to ask your question? Unmute yourself.
Yeah, sure. Hey, Leigh, and thanks for speaking with us tonight. So just going back to evaluation of trades. So let's assume the majority of us here do not have unlimited funds. So there's always a trade-off, right, when deciding what to place our bets on. So one of the criteria or parameters that I'm always looking at is margin requirement, because there's some trades that are juicy. I can get $10 in premium, but it may take 10K in margin requirement. I'm not willing to do that. So are there any kind of, like, going back to how you evaluate one trade versus another, what are some of the criteria? Do you look at return on margin, return on anything? Like, how do you make a choice between one versus another?
Well, really, like I said, I look at the stock charts and I decide what stock I'd be willing to buy at X price. And that's all it comes down to. If it's a $50 stock and I want to buy it at $30, I'm going to sell that $30 put option. Doesn't matter what the margin requirement is. Doesn't matter, what premium we're taking in. It's all based on what is the stock and what price am I willing to buy it for. And that's all that counts for me. And whatever it takes to put up the margin requirement, whatever the margin requirement is for that specific trade, that's what it is. So you have to decide, am I trading these put options just because I can get a lot of money from the put option, or am I trading this put option because I'm okay buying the stock at that strike price? So there's two theories of thought when people sell put options. It's one, because the premiums are juicy and they just want to sell that premium and get the money. Doesn't matter what the stock is, they don't care. That's pure speculating. That's pure gambling. That's just because you're seeing all the dollar signs and saying, "Ooh, I can get a lot of money to sell these put options." Or the other train of thought is, in the way we do it, is that this is a great stock. It's come off. I want to sell the put option and I want to buy this stock at a reduced price. And to me, whatever the strike price happens to be, that's what the margin requirement will be, however your broker handles your margin requirement. And that's just the way we do it. We're not looking to make a certain percentage on margin on any trade. It all comes down to, what is the stock, and am I willing to draw a line in the sand and say, I'm going to buy this stock at this price if I get a sign. And that's all it is. And that's the only way that we trade and sell put options. So that's our methodology. For you, if you found a stock that's got some really juicy premiums and you're still okay buying it at that strike price, if it comes down to that, then that's what you do, and you have to put up whatever the margin requirement is at that time. And if you can only sell one contract, then you only sell one contract. It all depends. Yes, account size does matter at sometimes, and it will allow you to either sell more contracts or not, and it'll allow you to sell contracts on higher price stocks. Unfortunately, your account value does dictate sometimes how much you can play with. But for us, my readers, one contract is all it takes. If you agree with the stock that I've picked, and you agree that, okay, I can buy this stock at this price, then you just sell the put option, and whatever the margin requirement is, you have to play it. You have to play with what the margin requirement is. So it all comes down to you. What's your train of thought? Are you just looking to sell put options to get money, or are you looking to actually potentially buy the stock?
Hey, Aaron, can I ask a follow-up there?
Say again?
For you, David, yes.
Yeah, just a follow-up then, Leigh. So let's assume I'm in it to own really good stocks at a cheap price. So as of today, there's a ton of great stocks on sale. So let's assume Visa, Disney, American Express, AMD, all the good stuff is on sale. And I'm happy owning any of those stocks. Okay. Again, I have limited funds. So if I want to, how do I evaluate one opportunity versus the other, assuming I'm good with any of those things?
Right. Well, that's that's the dilemma, right? There's a lot of stocks on sale. What do? You know, there's a couple ways to play it, and once again, these are not recommendations. This is just my opinions here. You can do a combo. You can sell if you have enough funds to cover one contract on each. You sell one contract on each. If not, you buy actual shares of stock on some of them. You buy a handful of shares on some and sell put options on the other. It's you have to get a little creative sometimes. And yeah, all those stocks that you mentioned are great stocks, and they're all at different prices. So it's going to take more margin money to sell put options on each one of those. It's a personal preference. You have to say, okay, here's number 1, 2, 3, 4, 5, and you have to rank them, I guess, and figure out which one's more important for you. Which one do you think will get the most bang for your buck? Which one will bounce harder? Which one's got the bigger dividend? If I can't do that, then maybe I'll sell a put option on my first two choices and buy actual shares on some of the others, or maybe I'll buy a deep in the money call option. That helps with limited funds as well. Options trading allows you to take many different positions with limited funds, and you just have to be creative sometimes and figure out what's the best way to play it. So don't think that selling put options is the only way. I've been dabbling in this market as well. I've been nibbling here and there. I've been buying shares on the down move, and I've also been selling put options. I haven't done any deep in the money calls yet because I just don't think we're going to have a sustained run back up yet. So I haven't done that. So I've been selling put options and buying actual shares, and that's something maybe you might want to think about employing. I know there's a lot of good companies out there that you want to get your hands on all of them. So just figure out different ways to employ your capital at this point. Hope that
Thanks,
helps.
Thank you.
Leigh, would you mind actually taking a use case to roll a put? Gino Borelli, would you mind unmuting yourself? I don't even know what stock you're talking about. Is it PayPal?
That's PayPal, yeah.
It is PayPal? Is that the ticker for PayPal?
Yeah.
Well, so Leigh's familiar with PayPal. I don't think it's anywhere near Leigh's strike price though.
PYPL.
Yes. So basically, I have it expiring tomorrow. I sold the put at 114. Of course, I missed out, hung on to it too long. So I think today closed in just a little over 100. So unless there's some miracle and this thing spikes tomorrow before close, which I doubt, I just didn't know, and I don't mind owning it. It's just maybe I was thinking of rolling it, but I've never done that. So I just wanted your input on that.
So let me bring up the screen here, and I'll.
Thanks, Leigh.
Thanks.
Okay, so PayPal closed just over $100 a share right here.
Yeah.
$100.63. It went all the way down to $82.50, and it's bounced back up, $17, $18 a share over the last couple of days, which is a nice bounce. Expires tomorrow. What'd you say? The 114 strike?
114. Yeah.
All right. So the good thing in this case is that, take a quick look here. So PayPal, and these expire tomorrow.
Yeah.
So the 114 strike, and PayPal's at 100. So it's, intrinsic value, it's about $14 or so.
Is that not the 27th? I think you're on March 20th.
It's March 2020. It's the month and the year, March 2020. So there's only one expiration left in March.
Yeah.
And that's all right. So the March 114 puts is basically all intrinsic value at this point, which means that option's worth about $14. The way to roll is that you need to sell you'll have to buy this. Rolling the put option is you buy back your current position and you sell a new position, hopefully for the same price that you buy the current one back. So now, if you want to roll, you have to find another put option that's worth at least $14. at a lower strike price. So what we can do is let's go out to September. $14. Wait, that's still March. Let me get rid of March here. So now we're looking at September. The September $105 puts right here. Now, one way of rolling, and just remember, this is not actual recommendation.
Okay.
All hypotheticals here. If you were to purchase back your March position at $14 per contract, and then sell the September 105s for $14. So you're selling these for the same amount as you're purchasing back the Marches, $14. You'd effectively be lowering your risk in the trade by $9 per share. Now you'd be selling the $105 puts, which you would hold on to for a while. If you wanted to go out to October, let's look at October for a second. October, you'd still probably have to sell the 105s as well. So you're looking at a situation where you can lower your risk in the trade by $9 a share down to $105 per contract at the strike price, right? So we've got PayPal here. So instead of potentially buying it at $114 a share, now you've lowered your risk down to the $105 level. And if PayPal keeps going up, then you may be okay. Let's just say with September and those expired and PayPal expired at 100. Well, now you'd only be looking at, a little less than a $5 loss, paper loss, until you decide to actually completely get out of the trade. So that's how rolling works. You look for a farther out expiration at a lower strike price that's worth the same amount of money
that you paid originally.
Then you have to pay to close your current position back.
Right, okay.
Does that make sense?
If you could just quickly go back on just the original, the 114, that's kind of what I'm not clear on in closing that out. So I have to close out the position first.
You have to purchase it back.
Buy it back. So obviously at a loss. But then I'm buying a September or October.
Selling.
Okay.
So you're going to buy you buy the 114s back for the $14 per contract, and to make up for that loss, you're going to sell the new one for at least $14 per contract as well. That's called doing it at even money. You're doing the spread at even money. You're buying it at 14 and you're selling the new one at 14. That's called doing the spread at even money, right?
Okay.
If you could do it for a credit, it's even better. Let's just say you could sell the Septembers for $15 a contract. Well, now you're going to bring an extra $1 per credit of credit, right? So when we roll trades, we always try to roll our trades for either even money or credit. That means we're selling the new one for even more money than what it costs to buy back a current put option. We like to do it for credit. In this case, getting even money is probably your best bet here.
Right.
And you're lowering your risk in the trade by $9 per share. That's how rolling works. It's a great defensive mechanism. Unfortunately, you can't roll it to a strike that's lower than the current price of PayPal, but you're doing a lot better than you would be if you didn't do anything.
Okay. Well, thanks for the explanation.
All right.
Excellent. All right, we're getting pretty late. So can I ask a favor? I'd like to take a picture for Leigh. Because Leigh, can you see everybody?
I only see people along the top. I see a handful of people.
Okay.
Along the top of the screen.
Anyone who's willing, could you turn on your camera? And especially if you have Leigh's book, could you show it? I'd like to take a picture for Leigh, so I'll send it to anyone else with the book. Oh, Larry's got his. Excellent. Thanks so much. I'll take a picture with. Oh, Gino's got his. Nice, Gino. So I can't quite fit everyone in the screen. Oh, we have two screens. Oh man, there's so many people here. That's awesome. Oh, that's great. Oh, my Steve's got the old copy. I love it. Thanks, everyone.
I appreciate everyone having the book. That's I hope it's been educational for you all.
Any more supply issues in Canada with the book? I hope not.
The last time back in, was it November when we had the last chat, Erwin, and everyone was asking me about the books. I thought I had some at home and I didn't have any. And I still to this day, the publisher has not gotten back to me. I can't get through to them. I don't know what's going on. So I can't get my hands on any at the moment, even for myself, which is not good. So I'm sorry to disappoint. I know some people had contacted me, so I apologize about that, but I still can't even get through myself to the publisher. So maybe I have to start using somebody else.
I'll just read you one of the comments, Leigh. Larry says, "It's my Bible. I have recommended to anyone who asks me what I'm up to."
Thank you.
I'll send you this video clip, and so you can see everyone who flashing up their books. That was awesome, guys. Thanks for that. All right, Leigh.
Thank you, everybody.
Thanks so much for going over time and being patient with us, crazy Canucks.
Yeah, no worries. No worries. We're all stuck at home, right? We're all stuck in a house. This is like the next thing to being in front of people. So.
Yeah. And Leigh's daughter is stuck with him as well behind the glass door.
I don't know. You can see it's my daughter behind me on the couch. If anyone could see.
All right. Happy trading, everyone. The futures are slightly down right now, but I think the same thing happened this morning. It was slightly down, and then we had a rocking day. So excellent. All right, Leigh, thank you again.
All right.
Thanks, everyone, for tuning in. And we'll have more details around Stock Hacker Academy version 2.0. Just know that it'll be April 25th, 26th, 9 to 5-ish. So if you want to block off that time, there'll be a nominal fee for anyone who's already taken the course with me. All right, and then we'll have a link as well for anyone who wants to purchase it. I think you've all probably bought it already, but in case you know anyone wants to learn more about this over a full weekend and also over 8 weeks and a full year of Leigh's newsletter. All right. Thanks, everyone. Thank you again, Leigh. Happy trading tomorrow.
All right, Erwin. Thanks. Bye, everybody.
All right.